After years and years of putting money into retirement accounts, at some point the IRS is going to flip the script on you and actually force you to start taking money out of your retirement accounts. Now, if you're not exactly sure how these required distributions work, chances are good you'll be caught flat-footed and not know exactly what to do. So in today's video, we're going to talk about required minimum distributions, what they are, how they work, and what you can do with them. Hey everybody, I'm James Canole, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. So to start, what is a required minimum distribution, also known as an RMD? Well, what it is it's a distribution that you're going to be required to take from any of your pre-tax retirement accounts. So think traditional IRAs, think simple IRAs, SEP IRAs, pre-tax 401ks, and even Roth 401ks if they're still in your 401k. Really, it's an account or it's a distribution that you're going to be forced to take out of your portfolio whether you want to or not. The timing of it is right at age 72. So in the year that you turn 72 is when these required distributions begin. Now, how much is it? Those distributions are based on something called the IRS Uniform Life Expectancy Table. So in other words, they're going to look at your account balance, they're going to look at your age, and essentially say based upon your life expectancy, according to their life expectancy tables, you're going to have to take out a certain amount each year. So let's look at an actual example. When you're taking your required minimum distribution, let's assume that you turn 72 this year. What you're going to do is you're going to look at your account balance as of December 31st of last year. So your balance as of December 31st of last year is the balance the required distribution is going to be based on. The next thing that you do is you look at your Uniform Life Expectancy Table, or the IRS Uniform Life Expectancy Table, to see what is the age factor that they're going to use for you. So for example, looking at the Uniform Life Expectancy Table for 2022, at age 72, they say you have a life expectancy of 27.4 years. So let's say your IRA balance as of the end of last year is $100,000. They're going to say take that $100,000, divide it by 27.4, which is the life expectancy at age 72, and the number that you come up with is the amount you're going to be having to take out of your portfolio. To put it another way, it's going to come out to about 3.65% of your account that you have to take out that first year. So if your balance is $100,000, you have to take out $3,650 that first year to satisfy your required minimum distribution. And that's where it starts. But every year, that percentage is going to go up as the life expectancy is going down according to the table. So if we look at age 73, instead of having to take out 3.65% of your account balance, you're going to be forced to take out 3.78% of your account balance. So just a slight change, but it's a little bit higher than the year before. If you look out to later years, say age 80 for example, well at age 80, you're going to have to take out 4.96% of your account balance. At age 85, you would have to take out 6.25% of your account balance. Now these numbers just increase and increase and increase. As long as you live, that number goes up and up and up, which effectively means each year, if your account is growing and you're getting older, you're going to have to take out a larger and larger required distribution each year. Now this is just the minimum you can take out. You can take out more if you want to, but the required minimum distribution is the minimum amount you have to take out without paying a penalty. And by the way, if you don't take this on time, the penalty for missed RMD is pretty significant. It's 50% of the amount you did not take out is the amount you would have to pay as a penalty for not doing so. So the natural next question is, okay, well, how much do I pay in taxes on that? Well, it depends, and it depends upon your income. So if you're looking at this, let's say you have a required minimum distribution of $10,000. And maybe you have a pension and you have Social Security and you've got some other income sources. And before you take your RMD, your taxable income is $50,000. So your taxable income is just a combination of all of your income sources minus your deduction, whether it's standard or itemized deduction. So if your taxable income is $50,000 and you're filing taxes married filing jointly, that required minimum distribution of $10,000 is going to be taxed at 12% at the federal level because that's the tax bracket that you're in. Now, if we look at someone who has $100,000 of taxable income before taking out that same $10,000 RMD, well, they're going to be taxed at 22% on that distribution. So think of it just as income. In the same way, if you'd say, how much income do I pay on a bonus I might receive at work? Well, what tax bracket are you in? The lower your tax bracket, the lower the taxes that you'll pay on your RMD. The higher your tax bracket, the higher the taxes that you'll pay on your RMD. So where this gets tricky isn't necessarily if you're already in a low bracket and you have a low RMD. It's if you've done a really good job of saving and you've maxed out pre-tax 401ks, or you have a significant IRA balance and that just keeps growing and growing and growing. Well, at the beginning of retirement, that might not seem like such a bad thing. Who doesn't like to see their account grow and grow and grow? Well, if that growth is happening in kind of the wrong accounts, so traditional pre-tax accounts, at some point you're going to be forced to start taking out pretty significant distributions from that. So it's not hard to see how an IRA balance that keeps growing becomes a bigger and bigger tax liability, because by the time the RMDs kick in, you might have 2 strong Social Security benefits. Maybe you have a pension. Maybe there's other dividends and interest you're already living on. And on top of that, you're forced to take out a pretty significant amount of your pre-tax accounts. That's where a lot of people run into tax issues. It's as the RMDs are stacking on top of already strong income that they get into trouble. But the taxes that you pay is going to be fully based upon what your tax base already is before the RMD, and then adding the RMD on top of that to see what tax bracket that puts you into. So that's how RMDs work when it's your own account. When it's your own traditional 401k or your own traditional IRA, that's how RMDs work for you. It's fully based upon the account balance as of the end of last year and your age. Those 2 factors are going to tell you how much you have to take out. But what if you inherit an IRA from someone? There's also RMDs on that. And by the way, those RMDs, they don't start at your age 72. They start immediately in the year after you inherit that account. It doesn't matter if you're 72 or 32. You're going to have to start taking out required distributions from that account based on a few different rules, which we'll go over now. The first thing to note, though, is we want to know, who did you inherit the account from? If you have an inherited IRA, or if you inherit an IRA, the first question is, did you inherit it from a spouse? If you inherited it from a spouse, you can simply take that IRA as your own. Meaning, instead of having to start taking required distributions the following year, that IRA can just fold into your own IRA, or it can become your own IRA, and you treat it the same way you would your own, which is it grows tax-free or distribution-free until 72 when required distributions kick in. But what if you didn't inherit it from a spouse? What are the rules then? Well, again, it depends. It depends on when you inherited it. Did you inherit this account before 2020, before January 1st of 2020? You're going to have different rules than someone who had inherited an account after January 1st of 2020. Let's start by looking at the individual who inherited the account before January 1st of 2020, before RMD rules changed. Well, that individual would have to start taking required distributions, regardless of their age, by December 31st of the year following the decedent's passing. So, maybe you inherited an IRA from your mother, from your father, or some other individual. You have to start taking RMDs the year following the year that they passed. So if they passed away on July 1st of the previous year, well, by the end of this year, you have to have taken your first required minimum distribution, and that required minimum distribution is going to be based upon the account balance, your age, and the decedent's age. So there's all kinds of calculators online where you can plug this information in, and those calculators will spit out the number for you, but you do have to start taking those distributions over the course of your lifetime, and again, it's regardless of your age. Here's the interesting thing with that too, is when we talk about RMDs and we talk about pre-tax accounts, the IRS is going to force you to take those RMDs because that's money that you haven't paid taxes on yet. And so they want to ensure that there's tax revenue coming in, so those distributions are required to begin at age 72. If you have a Roth IRA, there is no required distribution on it. There's not any tax revenue that comes from that, so the IRS doesn't really care when you take that money. It can keep growing and growing and growing. It's a different story with inherited Roth IRAs. With inherited Roth IRAs, they work exactly the same as inherited traditional IRAs, with the exception that you don't pay taxes on any amount that you take out. But you still are required to take an amount out. So if you inherit a Roth IRA from someone other than your spouse, and you inherited it before January 1st of 2020, you have to take a required distribution each year for the rest of your life based upon the account balance at the end of last year, your age, and the decedent's age. But just because it's a Roth IRA does not mean you have the option of not taking RMDs. You do have to take those in the same way you take them from an inherited traditional IRA. So that's pretty straightforward. In summary, if you inherited an IRA before January 1st of 2020 and it wasn't from your spouse, you have to take distributions over the course of your lifetime based upon the IRS life expectancy tables. But in January 1st of 2020, the rules changed. And the rules changed such that there is actually no RMD for a lot of people anymore. There's no required minimum amount that you have to take out anymore. Instead, the IRS says you must fully distribute the account over the next 10 years. So whereas before, if you were to inherit an IRA and could take out a little bit each year all the way until you're passing, now you don't have that option. The IRS isn't going to force you to take out one amount year 1 and one amount year 2 and year 3 and year 4 and so on. It's going to say do whatever you want, but by the end of the 10th year, this account must be fully distributed. So this is where tax planning comes into play. Let's assume that you inherit an IRA from a parent who passed, and maybe you're in your peak earning years. And now all of a sudden, you have a healthy income, maybe your spouse has a healthy income, and now you have this inherited IRA that you have to fully distribute over the next 10 years. What do? Well, ideally, you put a tax strategy in play to say if we look at your income over the next 10 years, are there years where the income will be higher and other years where the income will be lower? If so, what generally makes sense is trying to take more of the inherited IRA out in years where income is lower because you can do so at lower tax brackets. What that does is it puts less pressure on you to have to take out more income in years where income is higher because chances are good you'll be in a higher tax bracket. What you want to avoid is just kicking this can down the road. Some people will inherit it and they say, oh, I don't have to do anything for 10 years. Well, if you don't, you may run into a really tricky scenario in that 10th year where you're forced to take the whole amount out. And if you're in a high income tax bracket and that inherited IRA has been growing each year, that may be a ticking tax bomb that you have to take out all in 1 year on top of your income, and that could be a disaster from a tax standpoint. So ideally, you're putting a strategy in place of in years where income is lower, intentionally take more out. In years where income is higher, maybe take less out, but try to run some projections to see what does that look like? How much do you need to take out each year to level out the amount and minimize the overall amount that you'll have to pay taxes on over the course of those years. Now, if it's an inherited Roth IRA, same rules apply. No minimum amount that you have to take out, but it must be fully distributed within 10 years. Now, in this case, it kind of doesn't matter if you have to take out a really significant amount in year 10. In a lot of cases, it just makes sense to say, let's keep that amount growing because while it's in the account, it's growing completely tax-free. And if you don't need the money, let it keep growing tax-free. In the end of year 10, whether you're taking out $100,000 or $500,000 or $1 million in that account, doesn't really impact you because that's a tax-free distribution. So you want to treat inherited IRAs differently than inherited Roth IRAs because of the tax difference and how that's treated. Now, even though tax law changed or required minimum distribution law changed at the beginning of 2020, there are still some exceptions. And there are some exceptions if you are considered an eligible designated beneficiary. What does that mean? Well, if you were a minor child of the owner of the IRA and you inherited the IRA, you do not have an RMD for as long as you're still a minor. What happens is you can simply inherit the account, let it continue growing while you're a minor, and it's not until you reach the age of majority that 10-year rule starts. So let's say you inherited an account when you're 10. Well, for the next 8 years, you can hang on to that account and you're not required to have money distributed from it. But once you turn 18, now the clock starts ticking. And from 18 until 28, that's when you have to put a plan in place to start taking those funds out before the account must be fully distributed by age 28. So a minor child of the account owner is considered an eligible designated beneficiary. Again, that's not minor child, it's minor child of the owner, so keep that in mind. Another eligible designated beneficiary is someone who is fewer than 10 years younger than the decedent. For example, let's say you have an older sibling, and the older sibling passes away, and maybe you are 9 years younger than that sibling, and you have a younger sibling who is 11 years younger than the sibling who'd passed away. Well, in that case, you would have different rules for how the two of you have to take out your money if you're the two beneficiaries. You, if you're 9 years younger, you're within that 10-year window. You're within 10 years of the age of your sibling who passed away. So as an eligible designated beneficiary, you can now take out distributions over the course of your lifetime, just like the old rules. You don't have to fully distribute the account over 10 years. You can take a little bit each year or a smaller percentage each year over the course of your lifetime. Well, your younger sibling, who is 11 years younger than the sibling who passed away, because they're not within 10 years in age of the sibling who passed, they have to abide by the 10-year rule, where they don't have any required distributions, but the account must be fully distributed within those 10 years. So, if you are fewer than 10 years younger than the decedent, you are considered an eligible designated beneficiary and you have an exception to the 10-year rule. Another exception is if you're disabled or chronically ill. If that's the case, the IRS will also consider you an eligible designated beneficiary and you don't have to abide by the 10-year rule. You can take out distributions over the course of your lifetime. So those are the exceptions to the new rule, but any IRA that's inherited from a non-spouse from now going forward, really from January 1st going forward of 2020, will have to abide by that 10-year rule. Now, the final question is, okay, I know I have to take a required distribution. I know the amount now, whether it's over 10 years or over my life expectancy. What do I do with it? Well, there's three main options. The first one is spend it. If you're retired or you need this money or there's something you could spend it on, spend the money. The money has to be distributed. You're not going to get a tax benefit for turning around and reinvesting it somewhere else. So that's always the first option. The second option is reinvest it in another investment account. You're not going to get a tax benefit, but what a lot of people will do is if they have an inherited IRA and they're forced to take out an amount and they say, I don't really need that money, well, you can always turn around and invest that in a regular investment account. Or maybe you have earned income that makes you eligible for a Roth IRA or something like that. Well, as long as you have earned income and you're under the income limits, maybe you take your required distribution and fund a Roth IRA. What you can do though is based upon the options in front of you because of your age or income or work status, you can still turn around and invest it, but you still do have to take the amount out, pay taxes, and then reinvest it somewhere else where you're not going to be able to defer the taxes. And then the third option is something called a qualified charitable distribution. So if you're taking required distributions because you're at age 72, what you can do is you actually have the option of gifting that to a charity. This matters because in the past, a lot more people would itemize their deduction. Because in the past, standard deductions were much lower. Now that standard deductions are much higher, even people who are giving to charity oftentimes can't take advantage of those charitable deductions because they're taking the standard deduction. Maybe they have no mortgage interest, maybe they don't have much state taxes paid. If they don't have a higher enough amount of charitable giving, they're just not going to be able to deduct those deductions because they're taking the standard deduction. So, instead of taking funds from your IRA as a required minimum distribution, paying taxes on it, and then giving that money to a charity, and not even getting to realize the tax benefit of that because you're taking the standard deduction, what the qualified charitable distribution allows you to do is to send the funds directly from the IRA to the charity. And what it does is you don't pay taxes on it, the charity doesn't pay taxes on it, and it's effectively a way of not having to pay taxes on that distribution where you otherwise would have if you were to take the distribution first, gift the funds to the charity, but not be able to take that deduction because of taking a standard deduction instead. With qualified charitable distributions, even the required minimum distributions start at age 72, you can actually start doing these as early as age 70 and a half. So you have an extra year and a half or so to make these qualified charitable distributions. You'll sometimes see these called QCDs, and that can start at age 70 and a half. There is a limit. You can do up to $100,000 of a qualified charitable distribution from your IRA directly to a charity. If you're married and you both have IRAs that would support that distribution, you can both do up to $100,000, so $200,000 combined. But it is nice to know that option because if charitable giving is part of your strategy, and if you're taking the standard deduction, well, oftentimes the QCD can be a more effective way of giving those funds as opposed to taking the distribution first. Now with all of this, as is the case with everything, the key is to have a strategy. So with required minimum distributions, it's good to know how they work so you know what's in front of you. If you know what's in front of you, you know what you can begin doing today. You know what strategy you can put in place to ensure you're not doing anything or avoiding anything, even if it's unintentional, that's going to end up costing you a bunch of money in RMD taxes down the road. So with this, have a plan in place. Understand how RMDs work so that you can make the most of your specific situation. Thanks for watching. This is James Canal with Root Financial Partners. If you found value in this video, please be sure to share it with someone else who you think would find value in this video. Also be sure to like and subscribe if you haven't done so already. And if you want more great tips and strategies of how you can create your own secure retirement, be sure to check out our podcast, Ready for Retirement. And finally, if you're looking for our services or want to see how our services could potentially add value to your situation, check us out online at rootfinancialpartners.com.